Hello, I'm Tony Kaye. I'm the editor of Eureka Report, and I'm joined today by Rob Shand, who's Managing Director of Blue Sky Alternative Investments. Welcome, Rob.
Thank you, Tony.
Rob, I thought I'd have a chat today just about what Blue Sky does, and then perhaps sort of go into how investors can learn some tips from what you do, and in terms of diversification and asset allocation.
No worries. So, Blue Sky is Australia's leading alternative asset manager. Now, what does that mean? Effectively, we invest across four of the largest alternative asset classes globally, which is private equity and venture capital, private real estate, real assets, which for us has a particular focus on investing in water and agriculture, and then hedge funds is our fourth investment class. I think a good way to think about us as a business is that we are a private markets investor. So there's lots of good opportunities to invest on the stock market in listed equities. We focus on investing in unlisted assets.
Yeah, and that's one of the things for investors. We talk about diversification, and investors often think about diversifying across different sectors and different types of companies. But there's not too many opportunities to get into unlisted investments.
Yeah, it's actually a terrifically difficult thing to do, unless you're an institutional investor. Institutional investors globally invest about 20 to 30% of their portfolios in alternatives. So you've got the Future Fund here in Australia that's invested 39% of their portfolio in alternative assets. But unless you're an institutional investor, getting access to these sorts of investment opportunities is very hard. And we as a business exist to provide investors with those opportunities. If you look at the stock exchange, for example, the makeup of the ASX is actually, it's a bit curious. It's dominated by financial stocks, the big four banks. They make up 49% of the ASX 200, whereas you've got sectors like healthcare, which is I think 8 or 9% of the ASX 200. You've got sectors like IT, which is 1% of the ASX 200. If you're an investor and you want to get access to those types of industry segments that I think will continue to grow over the coming years, then it's hard to do in the listed markets.
And why have you chosen the particular sectors that you have in terms of unlisted investments?
So our focus across everything that we do, we call it the essentials. So investing in things people need rather than things people want. And so what you've seen our team focus on over the years is sectors like food, like water, like healthcare, like education, like technology. Many people don't think technology is an essential, and yet they carry an Apple iPhone in their pocket day in, day out. So sectors where there are long-term secular trends that are in our favour. Education's the third largest export industry in this country behind iron ore and coal. You've got this 2-decade-long trend of increasing international students, and here we are in Australia with a great education sector. We've got 4 billion Asians to our north, with an emerging middle class. We're in the same time zone. They want a safe country, English-speaking country, and here we are. It's an enormous opportunity, that one for us, as are our investors in things like agriculture, like water. We've all heard of the so-called food boom. Healthcare is an obvious one. Retirement is something that we're getting into.
Another issue for investors is getting exposure to international type assets, and quite often there's not too many opportunities there. So obviously what you're doing is having a global approach to how you invest and the types of assets that you're buying.
We do have a global approach. That said, our focus over the first 10 years of our business has been on Australia, and you'd expect that being an Australian headquartered company, but we do have an office in New York, and we both use that office to raise capital from large international investors, and the appetite for investing in Australia from those groups continues to grow. But we've also got investment capability on the ground there. So we've got a joint venture with a group called Cove Property Group. They invest in commercial real estate, with a particular focus on Manhattan. We've also got a number of private equity and venture capital investments in the US. Now, if you weren't an institutional investor, getting access to those types of investments from Australia, once again, it's very, very hard. But our business exists to provide investors with the benefits of access to those sort of asset classes.
And tell me a bit more about your water exposure.
So we specialise in that part of our business in investing in water entitlements. Now, water entitlements are the perpetual right, we focus on investing in water entitlements, particularly in the Murray-Darling Basin. And a water entitlement, in simple terms, is the perpetual right to extract a certain amount of water out of the river system forever. It's a perpetual right. And so every year you get given a certain allocation, and we sell those allocations each year to farmers, and that generates investors, our investors, a yield on that particular sale. Now, the thing that I love about water entitlements, if you think just simply about the simple supply and demand characteristics of that market, on the supply side, there are going to be no more water entitlements in this country. You've got capped supply. And then on the demand side, you've got this ever-increasing demand for Australian agricultural output. And if you think about what is the single most limiting factor in Australian agricultural output, it's not land. We've got plenty of land. It's not sunshine. It's water. So if you think about where the capital value of those assets is likely to go over the coming decades, in an environment of fixed supply and increasing demand, my view is it can only go in one direction.
So let's look at what's happening in 2017. We've only just got started, obviously, but what are some of the trends that you're likely to, or you're expecting to see through 2017?
Look, we as a business focus very much on long-term trends. Our investors, our institutional investors, groups like First State Super, like Goldman Sachs, like Partners Group, like LGIA Super, they're not investing with us, and nor is our network of high net worth individuals and family offices for the next quarter or the next 6 months. They're investing for the next 3 years, the next 6 years, the next 10 years. So what we're really focused is on long-term trends rather than what we think will necessarily play out this year. So our investment focus, which has been very much on the essentials over the last 5 years, will continue. We'll continue to invest in things like healthcare. We'll continue to invest in areas such as retirement, such as food and water, such as education. So that will be the mainstay of our business going forward.
And what sort of returns have you been getting across your investments?
So our track record since inception, our business was started over 10 years ago now, and that track record across the 4 asset classes stands at 16.7% per annum net of fees since inception. So it's a very solid track record over a period that spanned the GFC, and those times, as we know, they weren't easy.
No, very, very tough times.
But in those times of economic turmoil, I don't think there's a better place to play than investing in things that people need rather than things people want. So I think our investments in food, in education, in healthcare, in technology, they will all stand the test of time, regardless of the economic circumstances.
Oh, thanks for coming in today, Rob. It's been a pleasure to have you in.
Thank you, Tony.
And look forward to seeing more of what Blue Sky does down the track.
Thank you very much.
Thanks a lot.